Hey, 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 Bigger Pockets. I'm Paul Moore. Welcome to Bigger Pockets Live and Ask Me Anything Real Estate. I am Paul Moore with Wellings Capital and Bigger Pockets, and I want to make sure you can hear me. So if you can hear me, please give me a thumbs up or a smiley face, or let me know you can hear me. I do not see anybody on here yet, so maybe it's my fault. Can you hear me, Giselle? Hey, Agent Giselle. Looks like it doesn't look like I'm live here. Can you hear me? Oh, you can hear me. Okay, thanks, Sunset. Hey, Giselle. Hey, Stromberg. Hey, welcome, Stoner Parker. Glad you're here again. And if you are on Facebook, you cannot probably hear me because it doesn't look like it went live. So I do not know what's going on there. But I am going to have people join me over here on YouTube. So be patient with me while I really connect with these people here over on Facebook. Today we're going to talk about cap rates, folks. So if you have questions, you can hold them to the end. We're going to talk about cap rates in commercial real estate. So like I said, if you are on YouTube or if you are on BiggerPockets Live, hopefully you can hear me just fine. I'm donning my BiggerPockets hat today, straight from the Nashville conference. Whoever joined me at the Nashville conference, hello to you. We're going to talk about cap rates today. So why are cap rates important in commercial real estate? If you're a residential real estate agent and you want to move up to commercial, today is the day to hear more about this. Elijah, this is going to go about 20 minutes of content, and then we're going to switch over to some Q&A. So if you are looking to do Q&A, we're going to be doing that for the last half hour. So save your questions. I'm hoping Nate Shields is joining me. Nate is Dude Real Estate. He answers a lot of questions while I'm chatting. So today we're going to talk about cap rate. Now, what's a cap rate? Now, a cap rate is also known as a capitalization rate. And a cap rate or capitalization rate is the rate of return that you can expect on a given asset in a given location at a given period of time. It's a measurement of risk, and it is specifically a measurement of return because return and risk are inextricably linked. Okay, so the amount of return you're getting is directly tied to the risk you're willing to take. So if you're, for example, if you're willing to tolerate, if you want no risk at all, then you should consider investing in something that has like a no risk rate, like 1%, maybe 0.5%. If you're tuning in from Europe, and I know some of you are, then you are maybe experiencing negative 0.5%, -1, -1.5%. Thanks, Neil. I like the hat too. So the cap rate is a measurement of risk. Now, if you are willing to tolerate really, really high risk, like a development risk, like let's say you're willing to do a ground up development, and you are willing to tolerate that type of risk, then you're going to want a really high return. Okay, so people who buy stabilized multifamily, self-storage, mobile home parks, they might say, okay, this is not too high of a risk, so I'm willing to do that for, let's say, a 5, 6, 7, 8% return. Okay, that is essentially reflective of the cap rate. Now, if they are going to take the risk of ground up development, anyone who's been around a while knows that ground up development has essentially built in much, much higher risk. And so investing in ground up development, an investor is going to demand a much higher return, typically 10, maybe 12, maybe even 18 or 20%. That's an annual return. Okay, so that is effectively the cap rate. Okay, the cap rate is the capitalization rate, which is the rate of return an investor expects on a given asset at a given point of time in that location. Okay, and so let's take mobile home parks. Brandon Turner loves mobile home parks. I love mobile home parks. Now, they used to not be that popular, and they were kind of investors looked down their nose at mobile home parks, and they thought of them as fairly risky and not that attractive. And so the average mobile home park cap rate for years was 9 to 12%. Let's call it 10%. Now, as demand for mobile home parks has increased and the desire by institutional and large investors for mobile home parks has increased, the actual cap rates on mobile home parks have decreased. Okay, does that make sense? So the cap rates that used to be 10 or 12% are now closer to 6, 7, 8%. All right, hopefully that makes sense, because lower cap rate means people are willing to tolerate a lower return. And by the way, we're talking about an unleveraged return. So if I buy a house, and cap rates don't usually apply to houses, but let's just make it simple. If I buy a house and I have $100,000 in it, and I get $1,000 a month rent, that's $12,000 a year gross, right? Now, if my expenses are 33%, and therefore I'm netting $8,000 a year, my cap rate on that house is 8,000 divided by 100,000. That's 8%. So that's an 8% cap rate. Okay. Now, if I have debt, let's say my loan on that house cost me $4,000 a year. That comes out of the 8,000. That means my cash flow, my net cash flow, is only $4,000 a year. So 12,000 in revenue, 4,000 expenses. And that's houses, expenses for the house, and then 4,000 more in expenses on the loan. Okay, so that is $4,000 net cash flow to me, an 8% cap rate. Now, if I have a loan, I might not have had to put 100,000 cash into that house, right? I might have got, let's say, a 70% loan. I might have only invested $30,000 cash in that property. So $4,000 net free cash flow on a $30,000 cash investment, that's called a cash on cash return. 4,000 divided by 30,000 is, somebody do the math and let me know, it's something like 13%, maybe 13.3% if I did it right in my head. So check that out. So that is your cash on cash return. That's not the same as the cap rate. Like I said, the cap rate's 8% in that case. Okay? So what else do we need to know about cap rate? Well, cap rate's great because it allows you to compare different assets, different sizes, different locations, different asset classes, all to one metric, which is basically your return on investment. Cap rate's also known as return on investment, but we don't say ROI because it is a different metric. ROI is more similar to your cash on cash return, which I just mentioned. Now, the cap rate is calculated technically like this. It's the net operating income divided by the value of the property, okay? So if you have let's say $1 million property, and let's say your net operating income is $70,000. Your NOI is $70,000. That's $70,000 divided by $1 million. That's a 7% cap rate. And that's a pretty normal cap rate these days. Actually, there's a lot of properties that have lower cap rates. Now, lower cap rates translate to higher prices. Okay, so the value, taking this same formula, cap rate, again, is the net operating income divided by the value. Flip that formula around. The value of the property, and this is what appraisers in commercial real estate use, the value of the property is the net operating income divided by the cap rate. Okay, so if I have a let's say 120,000. Let's just use a real example. Let's say I have a mobile home park, and I go to the mobile home park, and I just bought it. And let's say there's a lot of cars sitting around, okay? And let's say there's boats and RVs and work trailers. You guys have heard this example before if you've tuned in before. But let's say I go in and I pave an acre of land out front of the mobile home park. And I say, okay, if you've got a third or fourth or fifth car or a car up on wheels or a boat or RV, you've got to put it in this fenced, gated area. Once you put it in this fenced in, gated area, we are going to charge you for the privilege of doing that. And that cost is going to be, let's say, $50 a month. Okay. The total of 1 acre, 1 paved acre, and now I'm using a real example, the total revenue from that should be about $10,000 a month. Okay. Now, $10,000 a month is $120,000 a year. Now, how much value did that add to my mobile home park? Okay, well, value is the net operating income, and that in this case there's no cost, there's no ongoing cost for this. So it's $120,000 a year revenue, which is the same as the income, divided by the cap rate. Let's use a cap rate of 6%. Pretty average cap rate these days. So 120,000 divided by 0.06 is $2 million. I just added $2 million value to that mobile home park once that's filled up and it's been operating a while. $2 million in value by adding a $100,000 capital expense. And that's a real example, by the way. That's an example that my company, Wellings Capital, recently invested in. And so very, very powerful. There's a reason, my friends, that commercial real estate, that most of the Forbes 400 wealthiest people in the world invest in commercial real estate. A cap rate allows you to compare different locations, different assets, different asset classes, because it is a one central number you can use to compare across a lot of different, like I said, different locations, etc. Now, Integra Realty Resources, IRR.com, has a lot of information about cap rates. And IRR.com says that the cap rate is effectively derived from 7 factors. The 7 factors are: number 1, supply and demand; number 2, the property income growth. Is this a property, in other words, it's going to be growing really, really fast? People are willing to pay a lower cap rate, in other words, a higher price for that property. Number 3, the cap rate's affected by the local economy, local job growth, and the unemployment rate. Number 4, it's also impacted by the national economy, national economic conditions, GDP growth. Number 5, a really important factor to consider is interest rates. If interest rates are really, really low, cap rates are typically lower as well. Now think about it. If people get a 0.5% in the bank or a money market, or from their let's say a T-bill or T-bond, they might be willing to tolerate a lower cap rate on the price of a property. In other words, they'll pay more for the property. Okay. Now, let's say that T-bills, T-bonds, interest rates in the bank account go up to 10% again, like they were in 1979 to 1981 often. Okay, even higher. If you could get 10% with virtually no risk, would you really tolerate a 5% return and take the risk of commercial property? Of course you wouldn't. Okay, so if interest rates went up to 10%, then the cap rate would probably go up to about 15%, which means the price of the properties would dramatically fall. Okay, because remember, value is income divided by cap rate. It's in the denominator. Now, the 6th factor that impacts cap rates is availability of financing. And the 7th factor is the risk premium of private real estate, meaning, there's, like I said a minute ago, there's several points of risk that people are going to tack on above the risk-free rate, the T-bill or T-bond rate, to invest in private real estate because there is a risk involved. So, what I'm going to do is give a couple examples of cap rates, and then we're going to dive into your questions. I hope this is helpful. So, let's say you had a 150 unit multifamily Class A plus in the middle of America. Let's say Kansas City, downtown urban area. What do you think the cap rate would be on that brand new property? In other words, what would people be willing to pay? If you want to guess, if you're on YouTube or BiggerPockets, please guess, and then I'll tell you what I think. Okay, so we're talking about a brand new 150 unit multifamily complex, downtown suburban Kansas City. What do you think the cap rate might be? Okay, Nick says 4%. Great guess, Nick. I think you're right in there, my friend. Who else? Who else wants to guess what you think this cap rate would go for? Okay, some V23 says 5%. Thanks, V23. Okay. By the way, there's not a right answer because there's going to be a range. Flood of Fins. Hey, Flood of Sins. Welcome back. 3%. Robert Dixon says 3. Mr. Majestic says 12%. Okay. K-Ecology, welcome back, says 5.5%. One Deal says 4%. Okay, you guys are mostly in the right range. The answer is going to probably be between 4 and 5.5%. Okay, I had someone the other day who I asked this exact question to said 3.5. I think that's a little bit pricey for Kansas City, like for middle America. I don't think it would be 6% or above. I think it would be in the 4s or 5s. Okay. Now let's go on to question number 2. What about a 150 unit suburban Kansas City Class B multifamily? Now it's 15 to 40 years old. It's got some old roofs, old HVACs that need to be replaced or upgraded. It's on the outskirts of town. It's in a nice area around the Beltway around Kansas City, maybe over there north of Overland Park. And by the way, it doesn't have to be Kansas City. It could be any town, any large suburban area, middle America, okay? I'm not talking about a mega city, just a medium, large size city. Someone said, is Grant Cardone buying? Well, if Grant's buying, I mean, the cap rate will be lower, right? Because he is willing to tolerate a lower cap rate. He has said so publicly, meaning a higher price. Giselle says 5%. Elijah says, how do you get... Okay, I'll get back to your question, Elijah. If I can, you might have to copy and paste it back. Ram says a higher cap rate. Nick says 5 to 7%. Okay, I'm going to go with Nick. 5 to 7%. Yeah, I would actually have guessed. V23 says 5 to 8. I would have said 5 3/4 to 6 3/4. Okay, 5 3/4 to 6 3/4. So basically around a 6% cap rate. Okay, now let's switch to middle America, suburban. That's right, Sean. Middle America, suburban Class C apartment. We're talking about 150 units again, but these are functionally obsolete. The bedrooms are small. It's a galley kitchen. It's in a decent location, but it's a kind of a rough neighborhood. I mean, it's a good overall location, but it's a rough part of town. It is not a war zone. It's just, that would be like Class D, okay? But Class C, multifamily, functionally obsolete. They might have some sewer pipes that are going to be rusty you have to fix. It's got some, it's going to be really, really hard to raise rents. Even if you make the place beautiful, you add beautiful appliances, and you do beautiful paint and carpet and fixtures, it's going to be really hard to raise the rent because people are not going to tolerate a rent increase, okay? So what do we have here? What do you think? 150 units, Class C, middle America, large city, like Kansas City. Robert Dixon says 9%. Okay, Nick? Nick says he's going to walk away from that one. He's not going to touch that one. Okay. V23, where you at? Come on. I need to hear from you. So what do you think? Class C. Okay, so Class A was in the 4.5 to 5.5 range, probably. Class B was in the 5.75 to 6.75. Class C, okay, Flood of Sin says Class C equals Section 8, yeah. V23 says 7 to 9%. I think you're right on. Robert Dixon says 9%. Giselle says 6.7. Yeah, I'm going to guess it's going to be in the very high sixes up to the 7, 8 range. I don't know that it would be a 9% unless it really had some stuff going wrong with it. So possibly 8%, somewhere in that range. Okay, we're going to fly through the rest of these. Okay, 150 unit Class B in Brooklyn. Okay, so it's not Manhattan, not the very heart of the most expensive city in America probably, but Brooklyn, which is an wonderful suburb of New York. What do you say? What do you say? Class B, 150 units, multifamily in Brooklyn. I'm going to take 2 guesses and then I'm going to tell you my guess, okay? Now, New York City's traditionally very, very expensive. So would love to hear what you think. New York City is going to be expensive. That's a hint. What do you think? Okay, Robert Dixon says 5 to 6%. This is Class B in Brooklyn. Mr. Majestic says about 5%. Okay, great. Who else? Anybody want to guess the cap rate in Brooklyn? I'm going to take one more guess. V23 says 5%. Okay, I've got it at 3.75 to 4.25%, right around 4% cap rate. Okay, Minot, North Dakota Mobile Home Park. We just invested in 2 of these. I'll just tell you that the cap rate would have been around 10%. One, you got it 3. Nick says 4.5. Yeah. Mobile Home Park in Minot, North Dakota, a town of 75,000 or so in the area, 175 spaces. It would have been around 10% cap rate. I would put it today at a 7 to 8%. What about a self-storage facility in Roanoke, Virginia? Who wants to guess that? It's a town of 100,000 or so. It's got about 200,000 people in the area in total. It's just your average middle America, middle Virginia town. Okay, Giselle, 5.5 in Brooklyn. All right, Juan says 8%. Okay, I guess you're guessing on this one. This is the self-storage facility. Okay, I'm going to guess around 6.5 to 7.5% on the self-storage facility. What about a triple net leased Google data center? I'm going to guess with the triple net lease, it means there's no insurance, no repairs, no utilities, no taxes. All that's passed to the tenant. Roanoke's a scary ghost town. Why do you say that? Butte? I don't know how to pronounce your name. Anyway, triple net lease Google data center, I would put it at a really low cap rate, like 3.5 to 4%. And that's not based on the location as much as it is the fact that Google is the tenant and it's a low risk arrangement, very long term, like a 20, 30-year lease. Okay, 15 unit Class B in a small town in Virginia. I'm going to put it at an 8 to 10% cap rate. How about a brand new ground up development, 900 unit self-storage facility in Minneapolis? Now, we just invested in one like this, and this is a trick question. I'm going to catch you if you don't be careful. That's not the Lost Colony of Roanoke. That's a different town, Butte. That was Roanoke, North Carolina. A brand new 900 unit self-storage facility in Minneapolis. Okay, brand new, just came out of the ground. Just raise your volume. Okay, thanks, Robert. So it just came out of the ground. It's just starting to lease up. It's only been open for, let's say, 2 months. What would you say the cap rate is on that? It's a beautiful Class A plus self-storage facility. It's 900 units, so it could have an institutional buyer, like a REIT could be the buyer on this. Where would you put the cap rate on this? Remember, cap rate is the last year of income, right? The last year of income divided by the value. So if an income divided by value is what was going into this, how would you calculate the cap rate on a brand new facility? Okay, Nick says 2 to 3.5%. Okay, Mr. Majestic, I think you're saying 2%. V23 is at 3.75%. So here's the deal. It's not fully occupied, like Nick just pointed out. And so you can't use the cap rate in the same way. You can't say income divided by value because it doesn't have income. It's new. Okay? So the answer is the seller would go, okay, I got $11 million in this, in building it, okay? I want to make a $2 million profit. That's like a 20, almost a 20% profit. So they'll price it at like 13 million. That's how the seller thinks. Now the buyer's going to think differently. They're going to think, okay, I can project the income from this when it's fully stabilized at, let's say, a certain amount. And I can say, since it's brand new, won't have any repairs, it's in the best part of town, it's Class A, I'm going to project that this cap rate is going to be 5.5%. It's in a great location. By the way, I'm talking about a real property that my company, Wellings Capital, invested in recently. Okay? So they would just basically go projected income divided by a cap rate of, let's say, 5.5%. And if they end up near the same number of like 13 or 14 million, hopefully the buyer and seller can get together. Okay? All right. So I'm done with my discussion of cap rates. What I'm going to do is I'm going to take some questions and I'm going to ask you, can you hear me okay now? Somebody said they couldn't hear me that well. Robert, can you hear me? So first of all, was that helpful? If it was helpful at all, please give me a thumbs up, a like, or share. I'm hoping the BiggerPockets isn't going to fire me. Okay, so I would love to get a thumbs up, a like, a share, a smiley face. And Zach, if you're watching, I'm just kidding. So seriously, okay, thank you. All right, so what we're going to do is Q&A. And so what I'm going to ask you, thanks Coin, I'm going to ask you if you could please copy and paste your question back in, because we have had easily 100 plus comments on here, and there's no way I can get back to all of them. I'm going to spend the next 30 minutes doing this, and then we're going to wrap it up at 5 o'clock Eastern. So Elijah says, how do you get money or equity out of your investment properties, not primary residence or Heloc? Cash out refi, rules on that. Yeah, Elijah, you're going to do a cash out refi or a Heloc, and it's basically the same. It's very similar effect. You can also just refinance, like the whole thing. Now, I'd recommend that you do a Heloc when you can, because you can pay off Helocs in ways, faster ways than you can a regular mortgage. Zinton Vivo says, what's the USDA loan requirements? I'm sorry, I don't know. Elbow Deep says you need to invest in a dialysis machine. Okay, I'm not sure what that means. Okay, Butte says, do you recommend any good comp analyzer software? Can you give me a little more information, what asset class you're talking about? That might help. Karan says, what banks are good for refi of non-owner occupied? I would go to a local bank, maybe find a local, a regional credit union bank like that. V23 says, what do you recommend a 17-year-old do to get started? V23, you were giving me some great answers, and you're 17? That's awesome. I'd recommend getting a paid coach if you can afford it, or a mentor. And a mentor would be where you go find a syndicator, a sponsor, something like that, and you basically try to learn all you can from them and offer your services for free. Hopefully that helps. You could also go to college. You could also get a job when you graduate in either asset management, property management, as a commercial loan broker, or commercial real estate broker. Those would be your best choices if you are 17. Mr. Majestic says, how do you work with real estate agents on multifamily? Thanks for the question. You definitely want to get in really good with commercial brokers. The first thing for you to do is read all the books. Like Steve Burgess has a great book on multifamily. It's called The Complete Guide to buying and selling apartment buildings. I wrote a book called The Perfect Investment. Read all you can. Go check out podcasts. Be all over BiggerPockets. Learn all you can. And then once you've learned the lingo, and only after you've learned it, go get to know commercial real estate banks. That's what I'd recommend. And get a small list that you contact at least twice a month. Larry Amsterdam. Hey, Larry, if you had $20,000 in cash, what would you do? Larry, I would look for a crowdfunding opportunity and hope to maybe double that money over about 5 years. That's what I would do. You could also partner with somebody, or you could also maybe put that $20,000 down on a $50,000 house. You fix up and sell. You could do the Burr method for sure, or you could do Brandon Turner's stacking method, where you would sell it and maybe you could turn that 20 into 40,000 cash, then do that again, turn that 40 into say 60 or 80,000 cash. Then you got some real money to work with. I think that's what I would do before I started doing the Burr method and building a portfolio. Vivo says, can you get an FHA loan out of state? I think you have to be owner occupied to do that. And my good buddy Nate Shields isn't on here today, or he would tell you. Elijah says, can't do a HELOC on investment though, because it's not your primary. You might be able, Elijah, to find a local bank or credit union or somebody who's way more flexible than you think to do a HELOC. I've got HELOCs on a couple investment properties right now. And so I think you can. Nick says, is it better to start a mobile home park from the ground up or acquire one already running? I can give you 100% certainty, Nick. It's better to acquire one that's already running. There are 44,000 mobile home parks in the U.S. About 90% or 40,000 or so are owned by mom and pop operators, and you can get some amazing deals. That's what my company does. We invest in mobile home park deals. By the way, we also invest in self-storage, and I just wrote a free special report on mobile home park investing or self-storage investing. If anybody asks, I'll tell you where to get it. Robert Dixon says, I also do crowdfunding. The downfall of crowdfunding is if you're a non-accredited investor, the IRS limits you to 5 or 10% of your income per year. Right. Yep. So Sean says, do you think becoming a real estate agent is a good idea while in college, or would it be more beneficial to use a management degree to get capital for investments? Sean, it could be either. I think you'll get a lot more experience from being a real estate agent, but if you're already in college and you're working toward a finance degree or a management degree, that's not a bad thing. It'll give you a lot more flexibility in the future. I think I'd need to know more. If anybody wants to jump on a call with me next Wednesday where I can actually hear your voice and you can hear back from me, ask me and I'll tell you how to get on the call. Where can you apply for a HELOC? Someone said line of credit. Okay. So you can apply for a HELOC at a local bank. Someone said someone said use a business line of credit. That's another thing I hadn't thought of. That's a great idea. Thank you so much, BMU. If you had $0 today, but you had your knowledge, what would you do to get back where you are now? Zvintine Vivo asked that. I would do a lease option sandwich, which is also called a rent-to-own sandwich, or I would do a corporate rental arbitrage. Okay, corporate rental arbitrage or rent-to-own sandwich are the two things I would do. You guys can look into more on that. By the way, if you want more information on that, if you want my special reports, and if you want to know about the corporate arbitrage, I don't have any information on rent-to-own or lease option sandwiches, okay? But I do have information on the corporate rental arbitrage in my two special reports. You can get those by going to wellingscapital.com/resources. Okay, that's my website, WELLINGSCAPITAL, wellingscapital.com/resources. That's RESOURCES. You can also hit me up on my BiggerPockets profile. You can just give me a private message and we'll get you that information. So Michelle, hopefully that helps. Thanks for your question. Elijah says, I see this trend of buying cheap mobile homes and selling them in financing. Yeah, I wouldn't buy mobile homes, Elijah. I would buy mobile home parks. You're buying the dirt and the infrastructure and the business. I would never buy a mobile home again. My friends, I bought 4 of them, and all 4 were a nightmare. 3 of the 4 were a total disaster, and 1 wasn't fun. Let's put it that way. Ernie Dog says, I have very low 700 credit score and 5,000 saved. Can I step into real estate rental game? Yeah, you could definitely do the corporate leasing arbitrage that I mentioned. Don't get me started on this, folks. If anybody wants to know, you're welcome, Michelle. If anybody wants to know about the corporate rental arbitrage or the rent-to-own sandwich, I will try to explain it briefly, but I don't have time to explain either one in detail. But it's pretty awesome, folks. I know a guy who was making $10,000 a month doing the corporate rental arbitrage, and he is training other people to do it. 2 of his students who have full-time jobs, these young, really aggressive, smart guys, just told me that I told them about this 15 months ago on a day like today. And they're now making $70,000. That's 70,000 a month gross. They're netting $35,000 a month using that long-term corporate rental arbitrage. So pretty cool. Robert Dixon says, can you do another live chat on either one or both of those? Coin says, what is that? I'm not sure what your question is. Sorry. Lease option sandwich was $0. Yeah, Mr. Majestic, it can be done. And again, I'm willing to go over the lease option sandwich if you guys want to hear about it. Marvin Bain says, do you recommend paying off loan balances on existing rental properties or using equity to purchase another single family rental? As long as you're not over leveraged, Marvin, I would definitely use the money to do another one. BMU 7979 says, how to get a phone call with me. If you guys reach out to me, again, I'm Paul Moore on BiggerPockets, and you can reach out to me there. And you can get information on how to get on a call with me. I never have enough time to answer your questions. So I do a call Wednesday at noon Eastern, and I just try to do my best to answer your questions in a little more personal way. I know I'm missing a ton of questions here, and I'm so sorry. Phantom Gets UGA 993. Job security equals 4 to 9 months per contract, 2 months average time spent between jobs, 30,000 saved up. It's cool. Is it realistic to invest, or should I acquire a long-term job before investing? DMV area. I know that area. I'm in Virginia myself. I would try to invest as soon as you can. Folks, I've said a lot of times, if I had to do over again, I would jump into commercial real estate as early as I can. And so, I'd highly recommend you check out the cap rate talk I did half an hour ago and jump into commercial real estate. I've done a lot of articles on BiggerPockets, and you should be able to find some of the articles where I talk about corporate arbitrage. It's the $10,000 a month article in your spare time, and also how to get into commercial real estate. I've never done an article on lease option sandwich. Sean says, I hope to chat with you soon. You're welcome, Sean. Thank you. How do you find a good mentor you can trust? BiggerPockets. Ask around on BiggerPockets and try your local area. Michelle says, information on corporate rentals. Yeah, you can hit me up for that at Paul Moore. BMU. I don't know which Paul Moore you looked up. There's 1.6 million people on BiggerPockets. But I'm Paul Moore with Wellings Capital. It is spelled that way, Paulmoore. Okay. ICE, the cap rate talk will be published minutes after I hang up today. Hang up? Is this a phone call? Anyway, no, after this video is over, it will be it should be online in the live stream. Joshua Harris says, I keep hearing people say that you do not want to be over leveraged. At which point do you realize you are, in fact, over-leveraged? Yeah, you know, Joshua, are you the Joshua Harris that wrote the book, by the way, Joshua? Are you in, Nashville? Would love to chat with you. You're probably over-leveraged if a downturn could take you out. So, in other words, if you're so close to the edge that if you get a higher occupancy, like if you get, several people moved out of your multifamily, or if your rents go down 10% or whatever, you want to look at the debt service coverage ratio, which is beyond the time I have today, but it's also called the debt coverage ratio. Okay, Joshua? And the debt coverage ratio, you want it to be 1.25 or above, but ideally 1.4 or above. Basically, it means that the amount of debt you have to pay, you get at least, after all your expenses, your revenue minus expenses covers your debt with about a 30 or 40% or more buffer. Okay? That's what lenders look at. That's what you should look at. Okay. So Giselle says corporate rental arbitrage. Okay. I don't have anything about that on my Wellings Capital website, except I can point you to my friend Al that teaches people how to do this. Hey, Patrick from Germany. So let me tell you how to do the corporate rental arbitrage very quick, and then I'll cover the lease option sandwich, and then we'll be close to wrapping up. So corporate rental arbitrage. There's a ton of people out there traveling for 6 months a year or more, like nurses, engineers, professors, students, people who have to stay in hotel for months and months and months on end. And they would rather stay in an apartment or even a home. So what you do is you get a month-to-month lease on an apartment. You get friendly with the landlord, the owner. You tell them what you want to do. And then you basically go out and go to the local hospitals, go to the local HR people at big companies, go to the airports, talk to pilots, and you try to find a place who has long-term corporate housing needs, okay? You also want to be near a Homewood Suites or a Marriott Residence Inn, and you can go out and hang out in their lobby and, maybe buy a beer or, hang out there and just ask people, hey, where do you work? Hey, would you like to live in an apartment? You can just do say you're doing a survey and do the survey till you get kicked out and find out if they have needs, like for long-term corporate housing. And then what you do is you set up that apartment. Hopefully you can get a month-to-month lease. Then you add internet, cable, water and sewer. You furnish it, and you can do some of this after you've got your tenant, but you furnish it, you get it all set up, and then boom, you bring in this tenant, and they're willing to pay 2 or 3 times what the rent is sometimes. So if you're paying $800 a month in rent, and then you've got another $300 a month in those expenses plus the furnishings, now you've got $1,100 a month in it. You might be able to get $1,500, $2,000, maybe $2,200 a month or more in certain locations. Okay? The reason I call it an arbitrage is you don't have to own the property to do it. That's why you can start very cheap. Okay? Now, what do you do when you have vacancy? Well, you put in Airbnb. You plug Airbnb on a very short timeline in during all the vacancies. And then whenever you have another long-term tenant, you put the long-term tenant in, hopefully 3 to 6 months, and you don't have to worry about anything else for a long time. Now, the profit on this is probably 90% of what Airbnb would be from what I've heard from my friend Al, but the effort is only a small fraction of what Airbnb is. Okay, so there you go. I'm going to take a few more questions and then get back to the rent-to-own sandwich. William Shields says, I'm moving to a new city in the new year. What are some tips in finding your first property in a place you're unfamiliar with? Get to know a realtor that you really trust. Interview 5 of them. Pick 2. Get to know them better. 5 over the phone. Get to know them better over coffee. Choose 1 and really get to know them. That's what I would do. Henry Escobar says, would you cash out, refinance a rental property that has 50% mortgage left on it? Yeah, I think as long as you're not in Florida or Las Vegas or California and some of those places where there's huge swings. And by the way, my debt service coverage ratio, I'd want it to be much higher in places like that. They're called the sand states for a reason. How do you feel about the NACA program for purchasing your first property? Thank you for the question, Donald B. I have no idea. By the way, that corporate rental program was the one where I told you my 2 new friends are making $35,000 net profit per month doing that, and they still have jobs. So if you want to get connected to training on that, I can connect you. I don't have the guy's email with me. Thanks for the question. Donald, I don't know what the NACA program is. I'm so sorry. Maybe you can tell me a little more. Hargren says, looking to purchase a single family residence via owner finance on terms, but I don't have much capital. Seller has tenant in place with very low rent. Should I sell, lease option, or raise the rents? So, in other words, would you want to do a rent to own from the individual, and then you're asking if you should do a lease option to the tenant? That's a good way to do it. That's a lease option sandwich, effectively. You just described it, if that's what you mean. Can you elaborate a little more, Hargren? I'm really trying to make sure I answer your question. You're welcome, Michelle. Hey, Kia, how do you find someone willing to agree to lease the property to you? Wouldn't they cut you out to get the profit? Yeah, Kia, so here's how a rent-to-own or lease option sandwich works. Basically, you find someone who wants to leave their property. It's been vacant a while, it's been on the market a while, or it's distressed. Maybe they're selling it, and maybe they can't sell it. Maybe they're about to lose it on the courthouse steps. So here's a quick example, okay? So I found a house that was on the courthouse steps in 2 weeks. I went to the owner, knocked on the door. I said, hey, I'm sorry you're going to lose your house. The courthouse steps means it's about to be foreclosed on by the bank, by the way. Okay? I do not know of a debt service ratio calculator, by the way. It's just, you can just do the math on it, I think. So Michael Blanc, B-L-A-N-K, by the way, has a great, somebody asked me earlier about a spreadsheet for a spreadsheet to analyze rental properties. See, I shouldn't try to do two things at once, my friends. Sorry. Okay, so I went to the guy and said, so sorry you're about to lose your property. How much are you owe? And he said, my mortgage is only $140,000, but with the back taxes, back payments, the court costs, the newspaper publishing, the attorney costs, I'm at $145,000. I said, so you owe $145,000 on this property. Now the property looked like it was worth about $175,000. That's not a huge spread, but that's not terrible, okay? So what I did is I said, here's what I'm going to do. You move out, clean this place up, sweep it clean, fix these shrubbery and all this stuff, which he was willing to do. You move out, and as quickly as I can, before it hits the courthouse steps in 2 weeks, I'll try to rent it out. If I rent it out, we'll do a deal. And so I rented it. His mortgage payment was, I think it was a really high interest rate. I think his mortgage payment was $900 a month, all in, okay? So what I did is I rented it from him for $900 a month. Okay, he was breaking even, but at least he had a renter now. I turned around and rented it to another tenant for $1,200 a month. See the sandwich, the bread, me is the meat, and then the bread on the bottom, okay? So there's a seller who wants out, who's renting it to me. There's a buyer, a tenant buyer on the other side. I'm renting it to. I make $300 a month profit, and I don't have any expenses. Now remember though, I had to pay $5,000 just to get in. Because he had $5,000 he had to pay to get his mortgage up to speed to avoid the courthouse steps. Where'd I get the $5,000? I got it from my tenant buyer. I made them put a $5,000 deposit down, maybe it was $6,000, and then I paid up his mortgage up to speed, and I rented it to him for $1,200. And by the way, I set the resale price for the new tenant buyer at $195,000. I said, this house is worth $175,000, but it's going to take you 3 years of rental payments to where you can actually buy the house, get your credit score up, and at the rate of inflation, plus a little bit of profit for me, I think it's worth $195,000. He totally agreed. He couldn't get a mortgage. And when he closed, I put $40,000 cash in my pocket. So it was a pretty good deal. That's a rent-to-own or lease option sandwich. One of the cool ways you can make money or get started in real estate without a lot of money. Okay, Kia says, please connect us to the corporate rental training. I can't do it right now, but get a hold of me, and I can definitely connect you to my friend Al. Okay? Toasted Toast says, I'm the in the highly expensive Miami area, but want to get into the BRR method with 30,000 available. Any tricks? Toasted Toast. Could you look out of state? I think it would be great if you can. I would highly recommend that you try to look out of state. Miami's so tough, but if you can maybe hold your cash and build it up a little, if there's a hiccup in the economy, if there is a downturn in the economy, it's very likely you will have an opportunity to use your cash to buy a great, great deal. I know somebody who bought for like $80,000 in the downturn. Now their house is worth like $220 in Miami. There's huge swings. BMU says, found some of my best deals on probate. You got probate data for sale. Okay, so get hold of BMU 7979. You can also put that in the BiggerPockets marketplace, BMU. Adam Janko says, is there a strategy for commercial arbitrage? Yeah, there is. And I've talked about another. If you want to get my special report on I've got a book on multifamily. You can get that free if you promise to do a nice Amazon review or just an honest one. You can also get my free special report on self-storage and my other report on mobile home parks, and basically buying from mom and pop operators that are way under managing it is the corporate real estate arbitrage of the year. I don't know why I said that. Anyway, it's a great corporate rental arbitrage, and I love it. And I actually wrote about this to my email list this week. If you want to get on my email list, you get these special reports, and we'll put you on it. One Deal says, why is investing in real estate better than the stock market? Let me count the ways, One Deal. Stock market has advantages, though, seriously. But like BMU says, it's a hard asset. Stocks can vanish. The Nifty 50 greatest stocks of the 1950s and 60s, many of those companies are gone now. They're not even in business. Their price went to zero. Now, real estate can go to zero, especially if you over leverage it. But overall, real estate it's a lot easier to see the path from operations to the money in your pocket. You're not going to get, dinged by a bad corporate CEO tweet. You're not going to get in trouble from a bad mood on Wall Street or an impeachment trial or a war in the Middle East. Real estate's way more predictable, solid, and stable. But I have to say, you also have to tie your money up for years, which you don't with stocks and bonds. That's an advantage of stocks and bonds. Okay, my friends, it's 4:54 Eastern, and I have missed over half your questions. And so thank you, Mr. Majestic. That's so sweet of you. Appreciate it, really. Patriot Man, is buying a house a bad idea now? No, just in the sand states, I think might be a bad time to buy. Okay, so here's what we're going to do. We are going to spend the next 5 minutes doing rapid fire. I'm going to do my very best to give very short answers on as many questions as I can, and we will go from there. So Joshua Harris, okay, you're answering Toasted Toast. BMU algorithms trade now. You're awesome, Paul. Thank you. Sean, enjoy the rest of your day as well. I'm going to enjoy my day because I haven't looked at how much money we've raised at my company today yet. And as soon as I hang up in 4 minutes, I'm going to go check that out because we did a big capital raise for self-storage and mobile home parks today. We work with passive investors, by the way, and so that's what we're up to these days. Robert says, thanks for sharing. Thank you. Give us a thumbs up, a like, or share the stream. Are you going to upload the stream? You missed some of it, Jesus. Yes, we're going to upload it, and we're going to talk about cap rates for the first 25 minutes. Okay. One Deal says, thank you. What's the best strategy for beginners? Corporate rental arbitrage and rent to own and lease option sandwiches. Mr. Rodriguez says, hello, Paul. Thank you. I really appreciate it. Are there really down payment assistance programs out there, Donald? I don't know about that. There have been in the past. Hobbs says, what's the best book I recommend? I would recommend The One Thing by the largest real estate broker in the world, Gary Keller and Jay Papasan. The One Thing. Adam says, thank you, Paul. I learned something new. That's nice. I'm glad, Adam. Seriously. The 121 says, I want to be in the Air Force and do real estate on the side. Will I have time to do real estate in the Air Force? Someone in the Air Force or the military needs to answer that. I'm not really sure. Robert says, do you have a YouTube channel? This is my YouTube channel. You guys are my family. BiggerPockets. So yeah, thank you. I don't have a separate YouTube channel. Sunset, why are the sand states bad? They're not bad, Sunset. They're the best place to make huge profits when you buy at the bottom. But they're the worst place to invest at the top. Okay? Does that make sense? So Joshua Harris answered and says he has time even though he's active in the Army. Andrew Reyes says, Paul, I want to invest with you guys, but I'm not an accredited investor. And we do work with accredited investors. Thanks, Andrew. It's good to see you on here again. Thanks. I know you've been on here a lot. Hobb says, what did I miss? You can check out the stream there. BMU says, buy probates. Okay. Turning single family into a duplex or triplex. Nathan, yeah, it's a huge benefit if you can do it without spending too much money and butchering the house. People make a lot of money by doing that, especially near college towns. Hope that helps. So the 121 says, okay, I'm not clear on that, but you're answering somebody else. Okay, it's 4:57. I'm going to take a few more questions and then sign off. So check out my BiggerPockets hat. Love this hat, and I'm really grateful to BiggerPockets. I cannot believe that I get to do this. Seriously, I can't believe that you guys are here. I'm so grateful. Ice says, I'm from Detroit. Would you invest here? Maybe. BMU, yeah, get hold of me. I can't believe I get to do this. I'm grateful to all you guys for showing up. Mr. Rodriguez says, do you happen to know any mentors here in LA? I probably do. Get hold of me. I'm going to have to think about it. If you can look up Jeremy Roll, R-O-L-L, and Reed Goosens, that's R-E-E-D, Goossens. He is a mentor to people from time to time, and both those guys are in LA. Donald B says, if flipping as an owner-occupier, do I have to pull all permits? I don't think so. I don't think you would if you're owner-occupied. Tell us about your best real estate deal. I'd love to. Maybe next time. One Deal says, South Africa, thanks for joining us. My friend went to somewhere Bay, whatever that town is. It's a beautiful town. BMU says, people invest anywhere as long as the price is right. You can't lose. Kia says, how do I get out of my parents' house with very little cash flow and build a real estate investing machine? House hack. Yeah, check out house hacking on BiggerPockets. What advice do you have for young officers starting out in the military? Hey, WG. Hey, thank you for serving, and thanks to everybody who already said, Joshua Harris and others said that they're serving in the military. Really appreciate it. A lot of people are grateful, and when Thanksgiving rolls around, we will be saying a thank you prayer for you next week. What advice? Again, same thing. I would do the corporate rental arbitrage, and I would do the rent-to-own sandwich. Jess Israel says mobile home wholesaling. Mobile home wholesaling might be okay, but I would not own and hold mobile homes long term. My friends, check out my mobile home park investing special report. Check out my self-storage report. Check out my book. And if you've read the book, The Perfect Investment, and haven't given me a review on Amazon, I would really appreciate it. I'm trying to get to 100 reviews before Christmas. And I do need to go on vacation and get a tan. It's probably these white lights. Thank you so much. All right. Blessings. Happy Thanksgiving. We'll see you guys all again after Thanksgiving. And I am so grateful that you're here and so glad to be with you. And I will be back next time here on BiggerPockets Live. Thanks and have a great day.